Steve, I'd love to take your temperature here on what's happening to tech, both in the short term in terms of like second quarter GDP revisions and so forth, but also this increasingly structural story we're talking about in terms of a digital iron curtain. What are the ramifications?
Well, we've been waiting for a correction in tech for a while, and we're finally getting it. A number of the companies that I've had reported in the last week, and particularly HPE last night, indicated that they are seeing longer sell cycles. So there is a macro effect that's happening. And then certainly for companies like Apple, China plays into it in a big way. So I think the uncertainty is a problem and may continue to be for tech.
All right, Brent, Facebook is up better than the overall S&P. The day after, they had this transparency report, their progress cleaning up the platform. They seem to be making progress according to their data, but does that matter? Should investors be watching those numbers?
You know, we think the big metric here is just what advertisers are saying. We had a call with many advertisers in the last week just stating that the ROI in the platform just remains off the charts relative to the other social platforms. So there's a lot of press headlines about, you know, privacy and some of the issues that are happening internally. But when you talk to the advertisers who are actually paying the bill, they're saying fantastic things, and they're getting one of the strongest ROIs relative to Amazon, Google, and other advertisers. So we think as long as we're hearing the good news from the advertisers and they don't care about the noise, then that's what investors should focus on. We still believe the company's capable of producing $10 of earnings a year out. You put a 20 multiple to 25, and you have a $200 to $250 stock. The stock's today 182.
Steve, the sell-off in semi stocks, do you think it continues?
I think it could. Particularly the semi and hardware names have really been lagging here, and they're getting pretty hard hit by the trade wars. You're finally starting to see some macroeconomic impact here. Companies like Pure, NetApp, and HPE last night are indicating that they're missing numbers, and there seems to be a macro component as well as to some company execution. A name like Apple, I think, is kind of fairly valued here. I didn't understand why it went north of 200, but their fundamentals are probably bottoming, but then you've got China overlaid on that. So I think there still could be some further downside here. We're certainly not at cheap levels for technology where I'd be comfortable buying.
Yeah, when you say further downside, Steve, I mean, we have seen some pretty crazy estimates for what long-term China damage could do to EPS in the realm of 29%. Does that seem reasonable to you?
Well, 30% would be if Apple sold nothing in China and they just basically shut Apple down in China. I would say that, for example, if their phones get tariffed in the U.S., that could be maybe another $100 to $150 expense per phone. That could hit earnings by, I'd say, more like 10 to 15%. So there's still material downside depending how the trade thing works out. I'd say 30% on EPS is pretty unlikely. Apple did get to a market multiple. I think that was pushing it. Now it's back to about 15 times, and I think it's around fair value.
Brent, Google, Alphabet, is down about 9% for the month. Not surprising, I guess, given the market's action. But what's your take on Google's exposure, either to ecosystem-wise, to Huawei and these China issues, or what's really having an impact on that stock and will drive it from here?
Yeah, John, what's happening to Google is the lack of transparency. So in the first quarter, they had a number that was below 20% growth. They've been putting up consistently 20% growth, and then that fell to mid to high teens. They did a very poor job of explaining it. So what you're seeing is a backlash from Wall Street saying, if you're going to give me the lack of transparency, I'm not going to give you a multiple. And so that money has flown into Facebook, Amazon, other names across tech. And so we think, again, it goes back to there's some issues that are going around on YouTube as it relates to brand safety. Advertisers are going to other platforms as there's been some short-term hiccups there. There's been core issues around what's happening with search, and is that being in terms of the market share being shifted over to Facebook, Instagram. So I think there are a number of questions. The multiple is not demanding. We like Google for long-term shareholders. We think, again, at the 10 times EBITDA, with EBITDA growing mid-teens, the stock is actually very reasonably valued. However, just this lack of transparency from a company, they're the only one in tech that does not provide guidance. among the big large caps. So without guidance and without a good explanation what happened in Q1, their multiple just continues to drift. It's unfortunate. I think that they could change their ways, but that's what's happening at Google.